Hi there, welcome to Kneppy Invest. It is important to have an investing strategy, particularly if you are a stock picker like I am. But it is also important, in my opinion, to be open minded in adjusting your investing strategy, particularly when it comes to suiting your own personality and just simply the way you are. For instance, when I started investing, it was all about finding those value companies. So, very much a Buffett like investing style. And you'll hear a lot of experts talking about that sort of strategy. But the thing that gets me a little bit peeved off or upset is when I hear those same experts say there is only one way to invest, my way of investing. And if you don't pick my way to invest, then it is wrong. I have also heard, say, in the last few weeks, a few of these experts saying that technical analysis is just like astrology. And in my opinion, if you don't look at charts within your investing strategy, you are investing with one eye closed. Now, you could also argue that that's the way they invest, but by disparaging a certain aspect of investing, like charting, I think you are being closed minded. And the thing about being open minded is you can take on different strategies, perhaps incorporate different strategies into your own strategy and improve your strategy. And I think I have done that over the past 5 years. I have incorporated technical analysis into my strategy, and my returns have improved. That is undeniable. So, for those who look down on technical analysis, those who disparage chartists, I think you are being closed minded, and I think you are doing yourself a disservice. So, when it comes to stock picking, and that's what I do, I am a stock picker. I do have two ETFs, but generally I am looking to beat the market, because if I can't beat the market, I just might as well put all my money into an ETF. So the sort of returns I am looking at are about 20% per year, but I'm always looking for ways to improve my returns. So I want to beat the market, and I'm looking at ways to get higher returns. And I am actually doing some projects. And the first project, or the only project I'm doing right now, is looking at significant days. So I'll discuss what a significant day is in the next few slides. So let's talk about my current project right now. And I am getting some really interesting results when it comes to possibly incorporating this sort of strategy or this technique, what you want to call it, into my current investing strategy. Based off anecdotal evidence, I know, particularly when I have looked at the past, that when a company releases a trading update, profit upgrade, or profit downgrade, that will have an effect on the share price after that initial day. So my thinking is, when a company releases a profit upgrade, there is going to be a normal market return for that company over a certain period of time. Wasn't quite sure what that period of time was. So that was my initial project, looking at the effect of trading updates on the share price over time. Unfortunately, I found this to be a fairly tedious task, because it is actually hard to get historical announcements. I did actually ask ASX for help, but they were absolutely no help, because what I wanted was some sort of filter where I can take all the ASX announcements over the past 10 years and then filter them down into groups, say trading updates, profit upgrades, profit downgrades, and they said they can't do that. And then I tried to go through a Commonwealth Bank, and Commonwealth Bank only has 5 years of announcements. So I wanted 10 years at least. And even then, when I went back 5 years, to go without any sort of filter, to go through every single announcement every single day was a fairly tedious task. So what I decided to do, instead of looking at announcements, what I'll do was look at significant trading days. And when I talk about significant trading days, I'm talking about where the share price of a company increases or decreases by more than 10% in one day. And more than likely, the reason why a share price might increase or decrease by 10% or more in one day is because of a significant announcement. And that would be a trading update, profit downgrade, profit upgrade, maybe contracts, that sort of thing. So this was a much easier task to implement than looking at the actual trading updates. So I am using Excel. I've also used a little bit of Google Sheets. So I'm increasing how I program within those platforms, or whatever you want to call it. Excel, Google Sheets, not sure what you call it. Now, I'm not a programmer, so probably the easiest thing we'll do was actually program some way to go through every single day, looking at for those companies whose share price increase or decrease 10% in one day. But I do have some filters when it comes to looking at these companies that increase or decrease, or their share price increases or decreases by 10% in one day. So we'll go through some of my filters that I have implemented in the next few slides. So just to clarify, that significant day is when the share price of a company increases or decreases by more than 10% in one day. I am looking at the data over the past 10 years. So starting from January the 2nd or 3rd, 2013. And what I'm looking at is future returns after that initial date. So I'm looking at the 1 week, 1, 3, and 6 month returns, and also 1, 3, and 5 year returns as well. But I am doing a fair bit of filtering out right now, and these are some of the filters I am using. Now, at this point in time, I have looked at every single company in the ASX 100 plus a few others. So over 115 companies I have looked at right now, 0 mining companies. And one of the I initially did include mining companies, and then I realized if I took the mining companies out, there was no signal. Absolutely zero signal, which does sort of make sense because what I'm looking at in terms of significant days is company specific news. But when it comes to mining companies, you might see the share price of those mining companies decrease or increase by 10% or more in one day, not based off mining or company specific news. It could be on commodity specific news. The commodity itself might decrease or increase in one day. And I have found, just based off what I've looked at in mining companies, there is no signal. And that will become clear when we look at the results I have achieved so far during this project. I've also excluded quite a few months in 2020, so between February and May, and the main reason behind that is the amount of volatility we saw in the market back then. And there are a lot of companies that have not seen a significant day over the past 10 years apart from that period between February and May. We're talking about the banks, those sort of companies. Also exclude share price lower than 20 cents, not 20 degrees Celsius, but 20 cents. The major reason behind that is when the share price is, say, 10 cents, it doesn't take much for the share price to decrease or increase by 10% in one day. So I am excluding a lot of the smaller companies on the ASX. And at this point in time, I have only included a few of the mid caps. I'm also excluding low liquidity companies. And the reason behind that is fairly similar to the reasons I've excluded share price lower than 10 or 20 cents is because from one day to the next, you can see a significant rise or drop in the share price simply because one person decides to trade. And I want to exclude those sort of scenarios. So far in my project, I do have quite a few samples, 229 samples for up days, 157 samples for down days. So we are getting to the point where I do have a significant sample set. Now, when you're talking about the 5 year returns, the samples will fall because when you're talking about 5 years, that means anything from between 2013 and the start of 2018 falls within, you're going to get all returns for all time periods. But for those days after 2018, when there is a significant day, we don't have the 5 year returns just yet because that's within the last 5 years. So we only have 127 5 year samples for the up days and only 67 5 year samples for the down days. And that will increase over time as I include more companies within this project. And I am including more companies. For instance, just today, I've included another 15 companies. It doesn't take long for me to go through every single company. It takes maybe 10 to 30 seconds to include another company within this project. So idea eventually is to include every single company on the ASX, apart from the very small companies within this project. So what are the results I'm getting so far? And these are fairly significant because if you had an investing strategy where you bought any company that had just increased by more than 10% in one day, you would actually do very well over the past 10 years. So in 1 week, it's 0.9%. After 1 month, 3%. 3 months, 8.3%. And after 16 or 6 months, you'd have a 19.1% return. And just imagine that over the last 10 years, the annual average return will probably be less than 10%. Might be just above 10%, but probably less than 10%. So you're almost doubling the annual return in only 6 months. And then I also had a look at those companies that had significant down days, and it's not as bad as what you would imagine. In the first week after that significant down day, share price almost steady, negative 0.1%. In fact, after 1 month, the share price had risen 0.7%, and after 3 months, down 0.2%. So share price of those companies generally goes sideways. And then that bad news has sort of filtered its way through the market, and we start to see the share price of those companies that released some sort of negative news that had a big down day start to increase. So after 6 months, the share price had increased by 2.3%, but nothing like those companies with a significant down day. So just by looking at this, all your focus should be on those companies that had seen a share price rise by more than 10% in 1 day, and totally ignore those companies who had seen the share price decrease by 10%. And the other thing to notice here is that after 1 week, share price had only rallied another 1%. So you can be patient. You can just wait your turn. And I'll talk about something else I've done later in the video in regards to that 1 week. And it's very interesting because what I did was I looked at those returns after 1 week. So for instance, those companies that rallied another 5% after 1 week compared to those companies who had a little bit of a dip. So a 5% dip after 1 week. And I thought it would be better to buy those companies that rallied another 5% and not focus on those companies that actually dropped in that following week. But the exact opposite happened. In fact, it was much better to take positions in those companies whose share price rose by more than 10% on that initial day and then dropped, say, more than 5% in the following week. It would have been the best strategy to buy those sort of companies. Now let's have a look at the multi-year returns using this sort of strategy. Just buying companies that have a significant update. 1 year return of 38%. And I will always take 38%. So this has opened my eyes up that this would be a legitimate strategy. All you have to do every day is look for those companies that rose by 10% in 1 day and then take a position in those companies. Now, mind you, at this point in time, I have only looked at the biggest 115, 120 companies on the ASX. It might change as I get into the smaller caps. But then you look at the 3-year return, 265%, 5-year return, 625%. Now, when you look at the significant down days, we're talking about 14% over 1 year, 68 over 3 years, 176 over 5 years. So even then, you're getting pretty good returns. Now, the reason you have to be wary just right now is because a lot of the companies within the ASX 115, and that's sort of my pool of companies right now, are those companies that have been highly successful over the past 10 years. We're talking about Pro Medicus is a prime example, a company that has significant updates over the past 10 years, and the share price increase for that company has been significant. So there is quite a few companies like that within the top 115 companies on the ASX. And those companies are influencing these numbers. As I increase the companies within this project, we're going to start including companies that have not performed as well. And I expect these numbers to actually decrease, particularly those 3 years to 5 years returns to actually significantly decrease as I continue this project and moving forward. So what is the future for this project? Now, I've already mentioned that I am excluding mining companies right now. When I say excluding mining companies, I have a different data set, and I'm not looking at mining companies yet. And when I excluded or put all the mining companies into the one data set, I found there was zero signal. between those companies that had an up day and those companies that had a down day, fairly significantly different than the non-mining company data base or data list. Anyway, so zero signal when it comes to mining companies. I have not included smaller cap companies yet, or even the mid cap companies yet. So I am down to about 115, market cap about $4 billion. I think the last company I looked at, let me just bear with me for a second. Last company I looked at was Metcash. Before that was AMP. Before that was Premium Investments, NextDC, Technology One, GQG, Bank of Queensland, Altium, JB Hi-Fi Cube, A2 Milk, Challenger Group, AGL, Harvey Norman. So Metcash, if I just have a look at Metcash market cap, which is the last company I did look at, 3.84 billion. The next company I'm going to include is Ansell. Then we're talking about NIB Holdings. Beach Energy will be put into my mining category. Fletcher Building, Brickworks, Boral, Chorus, Block, SQT, Perseus Mining, Liontown Resources, Net Wealth Group, Flight Centre, Eagers Automotive, Region, Stanmore, Zimplats, so quite a few, and Breville, so quite a few mining companies there that are what include in this particular list. So I'm going to go down this list. It takes me maybe 30 seconds to look at each company. So it's not a fairly long process, but that's where I am right now within the scheme of things in terms of sizes of companies. Now, what I'm also looking at, does the 1 week performance have an effect on the 1 month, 3 month, 6 month, and multi-year performance? And what I've found is if the share price increases by more than 5% in 1 day compared to dropping 5% in 1 day, it's actually better to invest in those companies that drop 5% in 1 day for the 6 month period. But when you talk about the 1 year period, it's almost identical returns, 35% compared to say 39% or something like that. But in 6 months, if you invest in those companies that drop by 5%, your return would be 19.5% or about 20%. And the return for those companies that actually rose another 5% in that first week after the significant trading day was only 14.3%. So the next thing I'm going to look at is, does the initial day rise or drop have any effect? So comparing those companies that rose 20% compared to 10%, will they have an influence on the end results? Would it be better to buy into those companies that rose 20% or even 30%? So even 100% or something like that. So I'm going to see if that has an effect on the overall returns as well. And then eventually I'll also break it down by years. Is this a reliable strategy no matter what year you're in? So what I would want to do or see when I do break it down by years is a consistent return for each year. So you might see some years be abnormally different or different than other years, but I want a consistent return in each year for this strategy to be a successful strategy. And I also hope to do examples. So go back in time and look at these significant up days, what caused these significant up days, and if there's anything we can learn from these significant up days. So I went back in time and I decided to look at the first company. And funny enough, I was a shareholder of JB Hi-Fi at this point in time. And this was probably the most shorted company on the ASX back then because of the threat of Amazon. So this was 11th of February 2013. Share price of JB Hi-Fi rose 17% in 1 day because they released their half-year results. Half-year results, branded stores sales up 3.1%, profit up 3%. Doesn't sound that interesting or that's amazing, but more than likely, the market might have thought that profit would drop for the half year, and because profit was up, the market absolutely loved these results and an increased dividend to 50 cents. The market absolutely loved these results. So in that 1 day, share price rose 17%. In the next week, after this significant day, the share price actually dropped 4.7%. So more than likely, this is the shorters who went, oh, share price has just risen 17% in 1 day. I can add to my short position. Maybe there was some profit taking as well. I remember back here, just before this announcement, the share price was something like $8 or $9. It was ridiculously low because of the short selling. And I thought, in my opinion, it was ridiculously low. Anyway, so after that first week, the share price started to rally. I'll show you the chart when I do this next video, looking at some examples, and the share price went on a really nice rally. So after a month, the share price increased another 17.9%. So don't be afraid to buy in after these significant days. So even though the share price of JB Hi-Fi rose 17%, the next month it rose another 18%. And that's including that first week of a drop almost 5%. So you could say after that first week, the next 3 weeks, the share price of JB Hi-Fi went about 22% higher. And then the first 6 months after the release of these results, the share price increased 47.1%. And then the share price of JB Hi-Fi sort of went sideways and pulled back. And see that in the next, in the 1 year, return was only 43.5%. And that is what I have found is the best returns tend to be in that first 6 months. And then after, or between 6 months and 1 year, you might see less influence of this significant day on the share price. But that's one thing I have found, and not true for all companies, but that is one thing to take into consideration, that the best returns seem to be in that first 6 months. That's all I have for this video, looking at my current project, which I am calling Significant Day, and with 1 year returns of 38% after a significant up day, we are starting to see some interesting results. And if I continue to see these results of 38% return after 1 year, as I expand this project to include more companies, I would become really intrigued. And I would even think about incorporating this strategy into my investing strategy. In fact, you could also argue just using this strategy would be highly successful if we continue to see these sort of returns as I expand the market. So really looking forward to see what happens with these 6 month and 1 year returns moving forward. So if you do have any questions about my current project, I'd love to hear them. So leave it in the comment section of this video. Otherwise, that's all I have for this current video, and I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.